$353 trillion, approximately, not including unfunded liabilities, of course. That is the total size of outstanding global debt right now. Governments, corporations, households combined. And here is the part that should make you stop and think. No one is actually paying it back. Debt loads are actually growing on a compounded basis. So the question isn't whether this resolves in some manner. It will, of course. The question is how, and who ends up absorbing the cost when it does. The Pied Piper always needs to be paid, because history tells us very clearly, it will not be the governments who borrowed it. Let me explain what I mean. Most investors watching the wrong things. They're tracking earnings, interest rate decisions, whether markets go up or down, this quarter or next. And none of that is wrong, but there is a much larger force operating underneath all of it. One that will shape investment outcomes over the next decade plus. Far more than any single rate call or earnings miss. And here is what I want to talk to you about through today. Not the scary number itself, but what it tells you about the environment you are investing in right now, and then the specific patterns to watch for as it plays out. Because this is not abstract. This is already showing up in markets. The first thing to understand is how this level of debt actually gets resolved. Governments rarely default outright. What they do instead, almost always, is allow inflation to run at a level that slowly erodes the real value of that debt. The number on the ledger stays the same, but the purchasing power behind it shrinks. You have seen this pattern before. Post-World War II, the 1970s, both periods saw governments carrying debts levels that they could not conventionally repay. Both periods saw extended stretches of inflation that transferred wealth away from savers, without fanfare, without warning, a stealth tax. And in both periods, the assets that held their value were the ones outside the currency system. Now look at what is happening right now. Central banks globally have been running monetary expansion at higher levels than core inflation, while debt levels remain at historic highs. That is not a contradiction, that is the playbook. Holding interest rates down lowers the cost of carrying the debt, allowing inflation to persist and gradually deflating the burden in real terms. If you are waiting for an official announcement that this is happening, you will wait a very long time. At Indigo Precious Metals, physical storage is taken very seriously. The Freeport Singapore offers a purpose-built, high-security environment built for exceptional assets. Advanced security infrastructure, around-the-clock operations, and in partnership with global leaders in secure logistics and vaulting, such as Malcolm Mint. Now let's get back to the video. The signal is not in the press release, it is in the data. Watch the spread between official inflation figures and the real asset price appreciation. Watch gold's behavior relative to the US dollar index. Historically speaking, when dollar purchasing power weakens over multi-year and multi-decade cycles, gold moves inversely and significantly. Watch central bank reserve gold accumulation, particularly from countries actively reducing the US Treasury holdings and replacing them with physical gold. That is not a retail investor trend. That is sovereign capital repositioning at scale. These are not predictions. These are observable patterns in the data right now. Mathematics has simply taken over. For an investor to try and make sense of this, the practical question is not whether to panic. It is whether your portfolio is structured to preserve purchasing power across a decade, where the base currency is highly positioned to be managed lower in real terms. Now, I run a precious metal dealership, of course, and you should factor that in how you weigh what I say. But the data is undeniable. At present, for example, silver has suffered the third largest 6-month price correction in the last 57 years. The largest was in 1980, after silver had rallied approximately 4,400% into the end of that commodity cycle. The second was during the global financial crisis, which was actually followed by a 500% price rally in silver. The third is happening right now, which has actually mirrored the GFC falls. But here is the clear distinction. During those previous major sell-offs, the physical market was operating in a healthy supply-demand surplus. Today, however, silver is now entering its 6th consecutive year of structural deficit. That changes the concept entirely. Historically speaking, every single major silver price correction has been followed by a substantial price recovery. Given the macro backdrop we have talked about, ongoing currency debasement, deteriorating sovereign fiscal positions, and a severe physical supply-demand deficit in silver in particular, I would view current levels as a significant buying opportunity for investors with a 5-year outlook. The question is not whether the structural case exists, it is whether you are positioned before the market prices it back in. Now, if you'd like my full written analysis on this, the specific indicators I'm tracking and how I'm reading the current macro setup, you can subscribe to my commentary via the link below. And if you'd like to talk through how this applies to your own portfolio specifically, then send us a direct message to arrange a complimentary consultation. Thank you.